Welcome to the debate. We are diving into one of the most persistent and frankly fascinating tensions in financial markets, the strategic choice between two fundamental styles of investing.
That's right. On one side, you've got value investing, really the search for discounted current assets, stable cash flow, often characterized by things like low price to earnings or PE ratios.
And on the other, there is growth investing. This is betting heavily on future potential, exemplified by companies like maybe an early Amazon or Tesla. These usually carry high PE ratios and reinvest profits rather than paying them out today. So the core question we are tackling today is, I think, pretty fundamental. Is an investor's preference for value or growth primarily a rational response to current macroeconomic conditions, like interest rates and inflation, or is this preference, fundamentally determined by deeply ingrained, non-rational factors like genetics and formative life experiences?
Interesting way to frame it.
My argument is simply that the choice of investment style, and particularly how it gets rewarded in the market, is overwhelmingly rational. It's driven by systematic macroeconomic factors.
And I come at it from a different angle. While I absolutely agree that market cycles determine when each style performs best, and certainly how much return they deliver, I believe the individual choice, that decision to become inherently a value or a growth investor, is significantly influenced by intrinsic personal factors, things like biological predispositions and the long-term psychological imprints of life experiences.
Okay. Well, my position is really based on the mechanics of financial valuation. Performance differences between growth and value are, I would argue, overwhelmingly determined by systematic external economic forces. And the single most crucial driver here is the cost of capital, which is directly tied to prevailing interest rates and, of course, inflation expectations.
Right.
Think about how we value growth stocks. Their significant cash flows are projected often, 10, 15, maybe 20 years into the future. When interest rates are low, the discount rate applied in those valuation models is negligible. This mechanically inflates the present value of those distant future earnings. That is the fundamental reason why the decade of zero-rate policy, say in the 2010s, was such a golden era for growth. Conversely, high inflation and rising interest rates, they raise the discount rate. This forces investors, quite rationally I'd say, to assign greater value to cash flow and earnings that arrive today, favoring the stable, cheaper assets found in the value cohort. If you look historically, the secular decline in inflation over the past 40 years, for instance, explains a majority of the decline in the ratio comparing value stock prices to growth stock prices. It really demonstrates the primacy of these macro factors.
Okay, I appreciate the mechanical argument, I really do. But I worry that focusing purely on market mechanics misses the crucial point about investor behavior. The macro environment absolutely explains let's call it the return profile, but I just don't believe it fully explains the investor's choice. Our commitment to a specific style seems far stickier than the constantly shifting interest rate environment. The research actually suggests that investment style preference has a profound biological and experiential basis. Consider the remarkable findings from twin studies, for example. These examine differences in investment style orientation using various metrics, including price-to-earnings ratios. And these studies show that genetic differences across individuals can explain somewhere between 18% and 25% of the cross-sectional variation in investment style preferences. That's kind of astonishing. We're talking about a significant portion of your portfolio allocation potentially being explained by your genes.
Up to a quarter, huh?
Exactly. Furthermore, investment style seems strongly shaped by what's called life course theory. These exogenous adverse macroeconomic experiences leave a persistent psychological imprint. Individuals who grew up during the Great Depression, for instance, say born between 1920 and 1929, showed a persistent observable preference decades later. Their portfolios had average PE ratios 2.2 points lower than those who didn't experience that trauma. That is not trivial. 2.2 points is a substantial lifetime allocation difference. It really suggests that the choice to be a value investor is less a cold, calculated financial decision and more maybe hardwired, conditioned preference rooted in early life experience.
I see why you raise the power of behavioral conditioning. But look, the rational investor should adjust their strategy to the environment, regardless of their sort of intrinsic preference, right? The current shift in the investment landscape we've been watching unfold is, I think, the most predictable, rational consequence of the end of the zero-rate environment. When the cost of capital was artificially suppressed, it lifted all growth assets indiscriminately. Now higher interest rates force a reckoning. This environment makes investors rationally demand returns today, which naturally favors the stable, cash-flowing value companies. We know historically that value tends to perform better than growth when U.S. interest rates are higher than, say, 1%. If we accept this mechanism, then a rational investor simply follows the dictate of monetary policy. It seems straightforward.
Okay, that explains performance. Yes, I grant you that. But if performance is purely cyclical and rationally predictable, why do thousands, maybe millions, of investors cling to one style regardless of where we are in the cycle? I mean, that's where the behavioral component becomes essential for understanding individual decisions, isn't it?
Well,
If value truly provides a long-term premium due to taking on systematic risk, which is the classic academic financial argument, right? Then that risk should be rationally priced and factored into one's portfolio strategy based on current financial models. It shouldn't be determined by the economic trauma one experienced in their teens. The fact that the style choice is incredibly sticky across cycles, enduring decades and major macro shifts, suggests that these non-rational ingrained preferences drive the choice of style, while macro factors only determine who gets rewarded for that underlying preference at any given moment.
sticky's a good word for it.
Let's delve a bit further into the non-rational evidence then. If we look at demographic correlations with investment preferences, they actually seem to contradict a purely risk-based rational explanation for the value premium. Investors who are generally expected to take on more financial risk, such as younger investors, men, those with higher disposable income or net worth, they show a distinct preference for growth investing, leading to higher PE ratios in their portfolios. Now, if value were objectively riskier, the higher risk takers should be flocking to value to capture that risk premium, but the data shows they are not.
I see why you think that points toward irrationality. But I would argue this correlation could be explained by differing perceptions of risk, rather than true irrationality. Let's remember how individual investors actually consume financial information. Many prominent investment managers and mutual fund companies explicitly tell their clients that, quote, growth funds represent a greater risk when compared to value funds, primarily due to volatility and dependence on future expectations.
Okay, so the marketing material.
Right. If the average individual investor, the subject of these studies you cite, genuinely believes growth is riskier based on what they're told, then their revealed preference for growth is a rational reflection of their higher risk tolerance and financial capacity. High PE ratios, in this view, reflect investor confidence in future earnings and the willingness to take on the perceived risk of expansion, not some kind of blind faith in an asset they think is completely safe. They are choosing what they believe are riskier assets because they feel they can handle the volatility.
That assumes a fully conscious, rational choice to align internal risk appetite with an external, often subjective, risk label. One which, as you know, often ignores objective financial data about underlying systematic risk factors. The behavioral research suggests the preference is rooted so deeply in genetics and long-term behavioral conditioning that it bypasses that kind of objective risk assessment. The Great Depression trauma, for instance, it appears to create a deep-seated preference for cheaper stocks later in life, independent of what a fund prospectus might tell them. And we absolutely must look at what happens when these behavioral preferences drive valuations to extremes. Consider the Nifty 50 group of blue-chip growth companies back in the 1970s. Despite trading at stratospheric valuations, those companies actually outgrew the S&P 500 by a massive 70% over the next 7 years. They delivered on truly astonishing earnings growth, yet they still underperform the market by about 40% because of the extreme starting valuations. This highlights that valuation tolerance, often driven by investor euphoria, a behavioral factor, is key, not just the rational assessment of growth potential. The market penalized them not for poor fundamentals, but for behavioral excess in pricing.
That's a fascinating anecdote about valuation excess, but it actually strengthens my argument about the rational corrective mechanism of the market. While behavior might exaggerate market movements, fundamental valuation spreads ultimately force a reversion. The current market conditions are, I believe, highly supportive of a value reversal precisely because of these extremes, independent of psychology.
You think the mechanics just take over eventually?
Essentially, yes. Valuation spreads between growth and value stocks on metrics like price-to-book (PB), which compares market price to book value, and price-to-earnings (PE), have reached extreme levels. In many sectors, these spreads are wider than they were even at the peak of the tech, media, and telecoms, the TMT bubble, back in the late 1990s. Extreme deviations from fair value based on fundamental macroeconomic drivers like inflation and real yields, they tend to revert over time. This statistical tendency for mean reversion implies a foreseeable rational rotation back into value, simply because the math eventually demands it.
That's a compelling statistical argument, fair enough. But have you considered that extreme positioning is itself a powerful behavioral indicator? I mean, when we look at global asset allocation, the proportion of equity assets invested in dedicated value funds has recently fallen to as low as, 5% to 10% in some measures? That looks like the statistical definition of herd behavior and euphoria, which are fundamentally non-rational drivers. It signals an extreme conviction that only growth matters.
It signals concentration, certainly.
And the consequence of this behavioral extremity is felt in how long it takes for a rational correction to actually pay off for an investor. Look back at the TMT bubble. Investors who bought high flyers like Amazon or Microsoft at the peak in late 1999 had to wait 10 and 15 years respectively just to break even on those positions. The loss was not due to poor fundamentals. As we know, those companies grew magnificently. The loss was due entirely to extreme valuation. Surviving that kind of long-term volatility, holding on for 15 years, requires immense patience and self-awareness, traits that are likely influenced by those very ingrained factors, those non-rational elements we discussed earlier.
Okay, so to summarize my position, macroeconomic drivers fundamentally determine the return regime. The current environment of normalizing interest rates, rising inflation expectations, and those historically extreme valuation spreads points strongly toward a multi-year regime favoring value. The rational investor adjusts their strategy based on these shifting external drivers, prioritizing financial science and the mechanics of the discount rate over, let's say, behavioral inertia. When spreads get this wide, the rational decision is almost forced upon the market.
And my summary is that while macro factors absolutely dictate market returns, the research demonstrates pretty clearly, I think, that investment style is not purely a cold calculation. It seems to be a profound reflection of individual differences, partially inherited through genetics and deeply conditioned by formative life experiences. Understanding these genetic and life course elements helps explain why investors maintain distinct styles, resulting in market behavior that often overshoots rational valuation and stubbornly adheres to deeply held preferences even when the math seems to point elsewhere.
This debate really illuminates the critical intersection between market mechanics and human psychology, doesn't it? While central banks shape the base discount rate, the individual investor's psychological tolerance for risk and valuation, the effective discount rate they apply, may indeed be partially explained by factors laid down at birth or during formative years.
Indeed. And the path to building wealth likely requires blending both, an awareness of those large macroeconomic cycles you emphasize, and a healthy dose of self-awareness regarding one's own inherent behavioral biases and conditioning. It's probably a mix of both worlds.